Hello. The company being analyzed today is Lenskart Solutions Limited. Today, we're going to analyze Lenskart's financials, its balance sheet, a credit report showing further information about the company, important information, and finally, its past growth and its future growth outlook. Let us begin with the financials. First, we have a market cap of 69,741 crores, price to earnings ratio of 283. Okay, return capital employed is pretty low, 5.57. Return equity is also low, 4.32. Okay. Here we have the profit and loss of the company from 2021 all the way to 2025. But on the right, we got sales, we got operating profit, we got operating profit margin, we have profit before tax. The final black number is net profit. So in fiscal year 2021, March 2021, company had sales of 905 crores. Let me do this also. These are the sales growth year on year. Okay. Sales growth. Then in 2023, company registered sales of 3,788 crores. So massive growth. You can see 152%. Then in fiscal year 2025, the company registered growth of 6,653 crores, growth of 22% year on year. Okay. Operating profit, the company has seen three consecutive years of operating profit, 977 CR, 15% of the operating profit margins. Okay, you see this number, 797, that is depreciation. Okay, 797 crores of depreciation. Remember that. Massive expense. 385 crores of profit before tax, and finally producing a net profit of 297 crores for fiscal year 2025. There have been talks, there was a one-off because of some acquisition, there was a one-off other income which they received, but we'll keep this straight, okay? 297 crores for fiscal year 2025. The sales growth last 3 years has been very impressive at a 64% CAGR, though last 12 months was 23%. While profit growth, it was not profitable, but then turned profitable. So a 4,938% growth in profits over the last 12 months. Okay. And last 3 years, 64%. Nice. CAGR in profits. 1% was the return equity 3 years ago. Last year was 4%. Then, interestingly, cash flow wise, the company is positive. Okay. Pay attention to cash flow from operating activities. Okay. So in March 2021, it was minus 117 crores. In March 2023, it turned cash flow positive, 95 crores, and has seen significant growth, growing to 1,231 crores of operating cash flow in fiscal year 2025. That is around 2% of market cap, I'm supposing. Okay. Fast growing company, the last year was not the highest growth, but profits grew massively and cash flow seems to be pretty good. Then let's see the company's consolidated balance sheet. Okay. Here under assets, let's see assets. First, you will see right to use assets. These numbers are in millions of rupees. So 21,085 million rupees or 2,108 crores worth of right of use assets, bigger than most other numbers. Uh, Basically, a lot of its stores, Lenskart stores, they're taken on lease. So the store they have taken on lease, the store will be recognized as a right of use asset, as far as I understand. That's what I want to show. Then in cash and cash equivalents, here cash and cash equivalents, an impressive 654 crores. Okay, 654 crores of cash and cash equivalents. Bank balances other than cash and cash equivalents, 210 crores. Total current assets of the company amounting to 3,330 3,300 sorry 3,630 crores of current assets. Let's compare this to current liabilities. Current liabilities, money they have to pay back within 12 months. How much is that? Total current liabilities of 1,868.5 crores. So it seems that the current ratio, that is current assets divided by current liabilities, is more than one. and it does have 600 crores in cash. Then we come to this. This is a credit report, credit rating by India Ratings. They've upgraded Lenskart solutions to in A, that is the credit rating, outlook stable. Under this, let's go here first. Strong market position. The company seems to have a strong market position. Here, focus on this. Lenskart's strong market position is demonstrated through the healthy store level operating metrics, including SSG of 15.7%. SSSG, same store sales growth. The company set up a store. How much did that store actually grow its revenue? So we are measuring that the company, is it growing revenue just by opening more stores, or are individual stores opened earlier, they are also growing? Very important metric for retail companies. Same store sales growth. A very healthy 15.7% same store sales growth. So nice. Then payback period. What do you mean by payback period? You invested in a store. How many months, how much time does it take for the store to actually be break even? Okay, break even. Above 80% of stores opened in fiscal year 2023 and fiscal year 2024 in India achieved payback by fiscal year 2025 with an average payback period of 10 to 29 months. Is this correct? Yeah, 10.29 months. Okay. So 80% of stores in India opened in fiscal year 23-24 achieved the payback period. They achieved break even. Now they're going to be profitable. In fiscal year 25, average payback period for 80% of stores in India, only India, was 10.29 months. And even more impressive, it seems, healthy repeat orders. More than 98% of repeat orders from Indian customers within 2 years. 98% of repeat orders. That's good. That's very nice. Then talk about number of stores. As of March 31st, 2025, the company operated 2,723 retail stores across 14 countries. Out of this 2,723, around 2,067 stores are actually located in India, with others being abroad. Okay, around 600 something stores are abroad. All right. Then, see, India, which spans 30 states and union territories, contributed around 60% of total revenue in fiscal year 2025. So 40% of revenue, it seems, is coming from international markets. All right, international markets. Hmm. The company's total retail area stood at around 2.32 million square feet. Million square feet, yes. India was 1.65 million square feet. International was 0.67 million square feet. So the international market is very important for the company. And store growth. The company has opened 334 stores in fiscal year 2025 and 430 stores in fiscal year 2024. So it's opening a lot of stores. Now, here we come across this vertical integration. I want you guys to pay attention to this. The company manufactured 13.16 million, that is 69.8% of its total prescription eyeglass sales in fiscal year 2025 through its centralized manufacturing facilities. So in fiscal year 2025, 69%, around 13.16 million of its eyeglass sales were manufactured through its own centralized manufacturing facilities. 6.44 million were in-house production. Okay, they're trying to increase in-house production. In fiscal year 2025, 6.44 million of these, what is it? Eyeglasses were in-house, increased from 4.44 million and 4.06 million. A bit confusing numbers. Basically, the basic thing is, the basic gist is they're trying to increase more of their in-house production and trying to rely less on others. Okay, fine. Finally, let's go to the future growth outlook. First, we have the store count. 1,400 stores in fiscal 2023 increased to 2,723 63 stores in fiscal year 25. As of quarter one fiscal year 2026, they already have 2,806 stores, and the Lenskart is planning to add 450 new stores in current fiscal year 2025, or focusing on tier 2, tier 3 cities in India and Southeast Asia and Middle East. So 2,723 stores plus 450, 3,100 something. Then company's future targets and strategy. Market leadership, long-term vision to serve 1 billion people with eyewear. That's a good headline. That's a good headline. Then they're launching B by Lenskart. It's an AI-powered smart glasses by the end of December 2025. All right, that sounds nice. Then aiming for consistent profitable growth, building on its recent shift to profitability in fiscal year 25. Okay, they're trying to improve the net margins by leveraging a centralized supply chain and automation. All right. For the quarter one fiscal year 26, revenues were 1,894.5 crores. Nice increase from 12 months back. Let's see the math. Okay, 1,894.5 crores. How much growth is that? Like quarter on quarter speaking, that is a 24% sales growth. Okay, net profit after, oh, look at it. Net profit 10.9 crores of loss 12 months ago. This quarter 61 crores. And EBITDA had a very nice growth. See, 336.6. Let's compare how much EBITDA grew. EBITDA grew by 83%. One thing, you see, the company's EBITDA though growing, its profits are not may not grow that fast because depreciation is also rising a lot. That's a non-cash expense. That's why profits for some time were negative because depreciation was so massive, but cash flows were actually positive. Because in cash flows, depreciation is not, subtracted from, because depreciation is actually added in cash flows. It's a non-cash expense. One more thing, we saw that there was 700 crores of depreciation for fiscal 25, but in its cash flow from investing activities, the company had new assets purchases of only 437 crores. So this depreciation could be, of course, it's growth capex. That's what I'm trying to say. There's a massive gap between depreciation currently and the amount it's actually spending on acquisition of new things. Then the Indian eyewear market is estimated at approximately $6.24 billion and growing at a CAGR of 5.26%, expected to reach 13 billion. The math does not sound right. 13.58 divided by 6. Wait, 13.58 divided by 6.24. Horizon is 5. Yeah, that's a 16%. That's 16%. So either Google AI is wrong or come on, that's a 16% CAGR growth rate. If the numbers are correct, 6.24 billion and 13.58 billion, then if those numbers are correct, then it's a high growth market, 16.8%. And because the market is largely unorganized and it's moving towards organized players may achieve even higher growth. Okay. And the global eyewear market was valued at $200 billion, expected to reach $335 billion. Again, 40% of its sales coming from international. International market is also good. It is very important. So it seems that both markets, if these numbers are to be believed, are growing very fast, especially the Indian market, and even the global one is growing at 8%. That was Lenskart. Um, One final thing to show here is this. The company seems to have a pretty healthy balance sheet. So compare the operating profit of the company to interest, the interest it pays on its loans, known as the interest coverage ratio. Very important. If it's less than one, that is concerning. If it's more than one, way more than one, then it shows the company has lesser and lesser risk of defaulting on its interest payments, which is very important. So you can see in the first few years, it's negative operating profit. So yeah, but we move all the way to fiscal year 25. You can see 977 crores of operating profit. We divided it by 147 crores of interest, giving out a 6.2%. Six, interest coverage ratio, which is pretty healthy. That is it. That was Lenskart Limited. Are you buying the IPO? Are you thinking of buying stock? Do tell down below.